So we're at about 800 lots right now in our portfolio. The biggest challenge that we've had is the management side. I mean, it
Okay.
takes a lot, and what I would say is that a lot of people go through this same situation. You know, you start buying, you start scaling, and then management has to catch up, right? So you're buying, and then you're like, wow, we've got a lot of stuff going on. So then you've got to catch up with staff and build those systems and create the efficiencies after you own the stuff. So it creates a plateau. Then you build out the systems, and then you can start growing again. Where mobile home parks are really going through this consolidation phase where you've got a lot of mom and pops that still own these communities,
Mm,
and so you've got professionals coming in and starting to buy them and bring in industry best practices, establish the best practices, let alone, bring them in. And so it's definitely more gritty still. There's opportunity in that, of course.
yeah.
But so there's, I would say, from a pricing standpoint, apartments are a lot tighter. They're a lot pricier from a cap rate standpoint.
What's going on, guys? Welcome back to the Life Outside the Mold podcast, talking all things entrepreneurship and encouraging people to step out of their own footprints and create a new lifestyle for themselves. Today, I'm sitting down for the first time with a mobile home park expert and investor, Mario Datillo. He's built a pretty sizable portfolio, and alongside, he runs his YouTube channel where he gives you the ins and outs of trailer park investing so you can create a lifestyle wealth through mobile home park investing. What's going on, Mario? Happy to have you here today.
Yeah, what's up, Cody? Thanks for having me on. I'm pumped about this. I love collaborating with other YouTube folks and other real estate professionals. So thanks for the invite. This is a pleasure.
Yeah, so let's dive right into this. Give me a background on who you are, and I know you didn't go to college. You're not really the traditional route type of person. Tell me a little bit about your kind of the journey you've been on so far.
So yeah, definitely not the traditional route. I was in high school, 18 years old, thought I wanted to go one direction, and somebody came to me and offered me a business opportunity. And I knew that I wanted to make money. I wasn't very good in school. And so I took that, and it actually was a marketing business that I started with a friend. And early on in life, I figured out that, hey, I want to get serious. I want to run a business. I want to make money. I want to have freedom of lifestyle. And so, yeah, after a few years, got into the real estate business after the company that we were contracted by filed bankruptcy on the marketing side. So one of my partners in that, we started a real estate brokerage and a mortgage company, and I ran the real estate brokerage. And I had no investment experience, but I was helping a lot of investors buy properties and help them make money, and had got the itch to really start buying some property myself. Saw that how much money there was to be made, and my dad had a lot of construction background. So I went to him and said, "Hey, look, why don't we partner up? Why don't you handle the construction side? I'll do the acquisition and disposition because that's what I had experience in, and let's partner." And
Mhm.
so we did. And after we bought some homes, I ended up shutting down the brokerage with my partner in that company. My dad and I just focused solely on buying homes and fixing them and selling them. And so we're flipping homes basically. And in 2009, had the opportunity to start buying some homes in Florida, and had the opportunity to buy some homes here where I currently live now. And it was blood in the streets. It was really a horrible, horrible place to own real estate at the time, but it was a great opportunity because it was really ground zero for the downturn here in Florida. So started buying homes down here, and in 2015 realized that we kind of wanted to get out of the single family side of things just because there wasn't nearly the distress. We couldn't buy from banks like we could before. We
Mhm.
weren't able to buy loans anymore, and we wanted to get into more long-term holds, and we decided to go the commercial route where we could buy something, generate cash flow, and own it for the long haul. So that's what we did, and that's kind of how we started buying mobile home parks, is right around that time, 2015.
So, what kind of led you to mobile home parks? Because a lot of people think commercial real estate got into either mixed use or apartments. Mobile home parks aren't really the fancy go-to commercial real estate. What kind of led you to that?
Yeah, and they really weren't in 2014, 2015. They were definitely the redheaded, ugly stepchild. Nobody really knew much about them, and so what happened was I was looking for apartment buildings. Going from single family homes to apartments was a very logical transition because the customer base is really the same. It's the consumer, and we were looking more on the affordable housing side. So we were looking for apartments, and a buddy of mine who is actually a commercial banker called me up and he goes, "Look, I've got this other bank friend that works in distressed assets for a bank. And they've got this loan. It's non-performing. I know you've bought non-performing loans before, but it's not on an apartment building. It's on a mobile home park. I don't know if you've ever looked at trailer parks, but would you look at this?" And I said, "Sure, we'll look at it." And I just studied up really fast. It was close enough to apartments where I could get comfortable quickly. And we bought that loan and haven't looked back. And we've really been focused on mobile home parks ever since.
So almost accidentally, kind of.
Yeah, it was totally by accident. We were hardcore looking at apartments, and this just came across my desk. I'm like, it kind of resembles an apartment building. There's definitely some nuances to it, but yeah, that's how we came across it and started buying them.
So where do mobile home parks weigh in terms of difficulty in sourcing the deal, operations, and management compared to apartment buildings? Because are apartment buildings more competitive? Are mobile home parks easier to source and find the deals, or where do those compare?
Yeah, so great question. I would say mobile home parks are really in a consolidation phase right now, where apartments are very well established. You've got a lot of institutional and professional operators running apartment buildings. There's a lot of professional management companies out there, where mobile home parks are really going through this consolidation phase where you've got a lot of mom and pops that still own these communities. And so you've got professionals coming in and starting to buy them and bring in industry best practices, establish the best practices, let alone, bring them in. And so it's definitely more gritty still. There's opportunity in that, of course.
Yeah.
But so there's, I would say from a pricing standpoint, apartments are a lot tighter. They're a lot pricier from a cap rate standpoint.
Yeah.
Operationally, they are similar in a sense. We have a lot less turnover involvement. So like when our residents move out, they're usually selling their home to another buyer. And so we're kind of like a homeowners association in the sense that we approve them, but we're not doing, make ready for the unit when somebody moves out. Where apartments, every time somebody moves out, you got to go in and make it ready to rent again. So there's a lot more turnover involvement with apartments than there are mobile home parks. That being said, sometimes we get a home back that has some turnover. We got to make the home ready to sell. But apartments are more management intense overall, but parks are more management intense when you buy them and you're turning them around. But once they're stabilized, they do get a little bit more boring. We like boring properties, and we rush. We do our best to get them to be boring, but they're never boring.
Something that just kind of prints cash. You have the operations down to a T.
Yes. Yeah. And it's still, there's still some involvement. So I want to be very honest. A lot of people say that mobile home parks are, cash machines because you just own the land, you don't own the homes, and it's just prints money. Not 100% true. There is management involvement and babysitting of the residents, a lot similar to apartments, but just not at the same level when they're stabilized.
Okay, so mobile home parks investing are generally like the lowest cost of housing, would you say?
Definitely. They're definitely the lowest cost provider of housing, usually about half the cost of a 2-bedroom apartment.
So does that make it easier to collect rent but harder to screen tenants than like a traditional apartment building? Like, have you found that with lower cost of rent comes lower class of tenant?
Sure. I mean, I would say we have to screen our tenants really well. I would say that our residents are often more homeowner mentality than an apartment tenant because they own their home. And so they are putting skin in the game. They're buying the home, they're fixing it up, or they're taking care of it. So there's a different profile. Although if you're not screening well, you can end up getting that tenant type mentality. We look for residents, like homeowner mentality, but you can come up with people who are more just renter mentality, and they're not going to take care of anything. So you got to be careful about that. And there is tight screening involved in it. But the good thing is they're buying the home, so there's some cash in it up front, which hopefully creates some pride of ownership.
So have you found that the screening process of like mobile home parks is more difficult than apartment buildings, or?
Great. Yeah, I think you asked me that up front, and I maybe didn't answer it straight on. So would I would say it's more difficult? No, we probably turn down more residents
Okay.
because you do have people who make lower income pursuing our housing because it's obviously lower rent. So yeah, we've got to screen out more people. But is it more difficult? Probably not. I mean, we follow the same process as an apartment building. We're doing background checks, credit checks, employment checks, things like that. But we probably filter out more than the apartments do. Keep in mind, apartments, they have a lot more turnover than we do. So they're probably, the average tenant in an apartment building turns over every year and a half, statistically, nationally.
Yeah.
For us, our residents live with us for 10, 15, 20 years. Some of our residents have lived with us for 30 years, and they've got half their family in the community. So it's a little bit different in that sense. So we're not doing nearly the screening and the apps that an apartment building would as well. So something to take into consideration.
So let's talk about lending. Why do banks only typically lend on parks where the homes are tenant owned and not owner owned, like someone who's an investor that owns the homes?
Yeah, so you went right into the deep stuff right away. Okay, I like this. So mobile home parks there's really two different business models. You've got this rental model, which is kind of like a horizontal apartment building, and the park owns the homes. Then you've got the lot rent model, land lease model, where the residents own the home, the park just owns the land, and you collect lot rent, and the resident owns the home. Now there's some debate, but I would say the majority of the industry recognizes that the land lease model is a lot better model. And part of that is because the homes are chattel. They are not real estate. They're like cars. Okay. So they depreciate in value. They have a finite lifespan to them. And the lenders are typically looking to lend on real estate because all of the terms in that loan are structured around a 20 to 30 year mortgage, depending on the type of lender. And so they want to lend on real estate. They're not looking to lend on cars or chattel like these mobile homes really are. And so what they're trying to do is protect their principal. And if you're lending on something that's depreciating, you've got to have a much shorter depreciation schedule like a car would versus real estate, right? So they don't want to lend on that. And so are there lenders that will lend on some homes? Yes, but they're typically going to be lenders who don't understand what they're lending on, and they're just purely lending on the cash flow. But the majority of the industry, the banking industry, is focused on the real estate aspect only.
Now, is there a reason these mobile homes depreciate so quickly, or is there a reason they depreciate instead of appreciate?
Yeah, I mean they're metal boxes. They're really and that's probably an exaggeration. The new homes are built pretty well.
Yeah,
that's not made of metal, but they are not built like single family homes, and they are considered chattel. They're considered personal property. So they depreciate similar to a car. I mean, you have pretty serious depreciation in the first few years, and then it slows down over time, but you're going to have that kind of bottom value, and they're not going to come back like a vintage car does. They will bottom out. And so they will hold a value, but they're not worth what they were before. So to answer your question, why? Because they've got a finite lifespan similar to a car. They're going to be they're not going to last 100, 200, 300 years like a good single family home would. They're going to last, 50, 60 years, and then they're probably going to get crunched.
Yeah. So what are lenders looking for in a mobile home besides park lot and returns, besides what we kind of just talked about tenant owned homes? What are lenders looking for?
Yeah. So what's attractive to a lender when it comes to financing mobile home parks? I would say that they're looking for an occupancy of 75 to 80% occupancy, physical occupancy, meaning homes sitting on lots. They're looking for stabilized cash flow, just like any other commercial real estate property. They also are going to prefer city utilities, so city water and city sewer over private utilities. Although that's not usually a deal killer, lenders will consider the private utility side of things, but it's just more attractive. There's certain they're definitely not looking. There's certain lenders that won't look at floodplains or flood zones, like Fannie and Freddie. They pretty much stay away from flood zones, where CMBS, life companies, and banks will usually consider properties that are in certain types of flood zones. And they're going to be lending anywhere from 65 to 80% loan to value. So you can get fairly attractive financing, especially through the agencies, the Fannie and Freddies. You can get up to 80% loan to value, much like apartments and multifamily financing. So there's some attractive financing. Amortization schedules are going to look something along the lines of 15 to 30 years, depending on the type of lender. Banks are going to be more that 15 to 20, maybe 25, where your institutional lenders are going to be more 25 to 30-year AM. A lot of them are the 30-year AM. So very attractive financing for stabilized properties.
Let's say you come across a property, and I'm sure this has happened a lot, where half of the park is tenant owned homes and half of the park is homes owned by the investor. How do you transition a mobile home park rental model to a lot rent model?
Yeah, great question. So if you buy a park that's got lot rent, and then half park owned homes, and you want to convert that, I actually did an episode on this because it was something I didn't hear anybody else talking about. It's a very strategic transition, and we learned kind of the hard way on this, and I won't get super into detail, but what you're doing is you're strategically expiring leases based on first your non-payers. So people who are slow or non-paying, you're going to start phasing them out sooner, renovating the home, and then taking those to market. And then over time, you're going to be looking at the residents who maybe don't show pride of ownership. They're not taking care of the home that they're renting. Well, you know that they're probably not going to be a long-term owner that you want to keep in the community. Even if they can afford it, you want to phase them out as well, just because you're looking for people who are going to show pride of ownership and don't have that renter mentality. They've got the owner mentality. And so you're going to phase them out next. And then from there, you're going to start picking out your best residents that you currently have, and maybe offering them the opportunity to buy their home. And then you're going to phase everybody else out and sell those homes. So it's you're doing it in phases. You obviously want to keep the cash flow up, which is the trick. So you don't want to go out to everybody and say, hey, we're turning this into a lot rent community. Yeah. Everybody, you got 60 days or 90 days or whatever that legal period is that you have to notify them. You want to keep the cash flow up and sell off homes as you phase them out. And so it's a little bit of an art. We learned the hard way. We kept a manager that had been managing a community. It was 100% park owned homes. And we told the manager that we inherited from the previous owner what we were doing. He got disgruntled about something that was pretty minor, and decided to go to all the tenants and tell them, hey, stop paying your rent. They're going to kick you out anyways. And and everybody stopped paying rent or bailed on us at one time, and it was a mess. So check out the episode I did on that if you want all the details. But it was a nightmare. It was expensive. Oops, I'll tell you that.
Yeah. So I assume are you buying in selectively red states, or are you buying in blue states as well?
Great question. We are not buying only in red states. I'd love to just buy in red states, just because those states are going to be a lot more landlord friendly. They're going to be a lot more reasonable and logical when it comes to the court process. And if somebody didn't pay, they should be out, right? I don't get to live someplace free. I don't get to not make payments on other things that I have. So why should somebody else be able to live in my property and live for free? And so ideally we'd be in only red states, but we're looking pretty much nationally. We avoid the West Coast and parts of the Northeast because they hate landlords. So why am I going to give them tax dollars and do business there? There's a few states in the Midwest too that we avoid, like Illinois and Louisiana, but generally speaking, we're looking nationally. And we do take into consideration landlord tenant laws wherever we're buying. So if it's a bad county or a bad market in general, we're probably going to avoid it. But we're trying to scale and grow, so it's hard to totally avoid blue states right now.
Yeah, that was kind of my question, was how much harder is it to evict a tenant out of a mobile home who's lives in a blue state that's not paying versus a mobile home that's more so in a red state? I assume it's similar to apartment buildings, but is that right? Or
yeah, it is. It's very similar. I'll quickly run through the process of how it generally works to evict a mobile home park, and then I'll answer your question directly. So you typically go through the same process that you would for an apartment or a single family home. So you're going to go through that legal process to evict, but because they own the home, technically they're supposed to be moving the home out when they're evicted. Nobody does, because if you can't afford the $300 to $500 a month lot rent, you can't afford the $3,000 to pick up and move that home, and then another $5,000 to $15,000 to set it up in a new community. So they leave their home, and then what you do is you file for abandonment. You go through this abandonment process similar to if someone left a car in your in your parking lot or in your yard. You would go through an abandonment process to obtain a new title in your name. And that's how it works. So we're basically, I don't want to say repossessing or foreclosing, but it's kind of a similar concept. Yeah. We take back that home, we renovate it, and then we sell it. So there is, in the blue states, the states that are less tenant friendly, we own in Florida, Georgia, and Minnesota, and we own some other property type self-storage in Florida and Texas. But I would say that Minnesota is a lot slower. They are a lot more forgiving. They're going to side with the tenant much more than they're going to side with the community owner. And you've got to kind of jump through hoops. I mean, they have this stupid process right now where everybody who is backlogged throughout COVID, they've got this slow path to eviction with them where it gives them this runway to redeem themselves. And hey, look, we work with our residents. We give them plenty of opportunity. We try through COVID. We did a lot of things that we normally wouldn't do just to help them be able to stay in their home. But ultimately, when somebody is not trying to pay and they're just trying to screw you over and work the system, they got to go. And so I'm not cool with government that allows scam artists to stay in homes. It's just not cool. I'll put them out.
So what type of scale deals are you looking at? Because like with lower rents, you have to look at some sort of deal size to even put a property manager in place, I would assume. What are the deal sizes you're looking at?
We're looking at properties that typically have 50 or more occupied lots. So it might even be a 200 space community, but if there's 20 homes sitting on lots, it's just not enough income to make it work. I mean, it's interesting because people focus on, cash on cash return and other metrics from a return standpoint. But ultimately, if it doesn't make enough dollars and cents, then it sometimes just doesn't make sense to do. And so for us, 50 plus occupied lots gets us to the point where we can comfortably afford an on-site manager, and we'll create enough of a spread over the expense load that gives us enough cash flow to make it worth it. That being said, in markets that maybe have very high rents, so parts of Florida, parts of even around the Atlanta market, we get pretty high rents, we would maybe look at something smaller. Or if it's in a market that we already own in, we've already got operations and a footprint, then yeah, I'm going to look at something a little bit smaller because we can use an existing manager in place to manage that slightly smaller property. But generally speaking, 50 plus occupied lots is where we start to get excited and pursue. The bigger, the better.
Now, would you say mobile home parks are harder to scale than apartment buildings, or would you say they're fairly easier too?
Definitely harder to scale. And there's a few reasons for that. Number one, apartments, you've got very professional management companies that do third-party management for them. Okay.
Yeah.
So if I want to go buy 1,000 units, 5,000 units of apartments, I can find good management companies in most major markets. And I can focus on acquiring and raising capital and building the acquisition side of things. And as I take them on, I pass them on to management companies, and I can manage the management companies, right? So focus solely on asset management and invest in acquiring more communities. On the mobile home park side, we don't have that luxury yet. There's not really, there's not many, I shouldn't say many, there's very few professional management companies that manage mobile home parks and do any bit of a good job, okay? Most of them are terrible. And part of it is there's not as much money in it. So if I'm going to just do third-party management for owners, why am I going to go manage something that produces $300 to $400 a month in rent per unit versus $1,200 a month, right? So there's the same amount of work, but a lot more revenue because you're getting paid a percentage of the revenue. So there's just not a reason to manage them. But also, the ones that do struggle because it is this really unique business model where it's a hybrid between a rental model and a sales model. So it's kind of like a homeowners association and a builder developer blended together. And there's a lot of project management with bringing in homes, sales, things like that. And there's a lot of capital improvement, capital involvement where apartments don't necessarily have that. You usually have some upfront money and you've got some minor turn costs that are part of your operations. But with mobile home parks, you've got this sales model involved. So it's very hard to do without really having a pulse on the capital and the project management side. And management companies just aren't set up to do that. So I would say from a scaling standpoint, apartments are far, I don't want to say easier, but it is easier. Mobile home parks, when you get into mobile home parks, you need to anticipate starting your own management company and managing them in-house. And if that might mean doing what I did and hiring great people with good management experience to run that company, but I had to start that management company. We couldn't just go hire management companies in each region and let them run them for us.
So let's see, what's your current ratio of offers submitted? Like, do you have a ratio to close like one deal? Like for sizable apartment buildings, like Tim says he may have to submit 400 offers to get one accepted. Have you noticed a significant different ratio in mobile home parks?
Not really. I mean, it's probably somewhere around that range. I don't have the exact number, but I would say it's probably, one in 100 to 200 get accepted. And then out of that, you've probably got probably a third of those close.
Okay.
So it probably comes pretty close to what he's saying, just because you do go under contract with things, you find things that are significantly wrong or something that was not accurately portrayed from the seller. And so, they fall through as well. So I'd say it's probably pretty similar. There's a lot, it's definitely a volume game. You've got to be looking at a lot of properties. You've got to be underwriting and offering on a lot of properties to find the ones that are going to fit. And the truth is the majority of the stuff on market through brokers is trash. I mean, it's really a waste of time to even look at because they're calling and saying, hey, I've got something that's a 4 cap that's stabilized and it's got 0 upside on it. And, that might make sense in the apartment world. To me, it doesn't make sense in the mobile home park world. So it is definitely a challenge to find good deals.
Back to like the own the land, not the park. When you see deals, like I know we addressed, like when you see deals, you still look at them, the transition rate to turn those over of when the investor owns the uh, mobile homes, they aren't tenant owned, you will still look at them. Is that right?
Sure. Yeah, we'll look at deals with park-owned homes, but this is kind of the gauge or what determines if we'll actually pursue it is the market around it, the neighborhood that it's in. So you you may have someone that has been operating that community as a rental community because that's what they prefer. They like the higher rental numbers. They don't care that it's a lot more management intense and that there's a higher expense ratio. They don't care. They just run it that way by choice. And then there's properties that are being run that way because that's what the market requires. People aren't interested in that market to buy something. They're just renter mentality. So usually the low income areas, they are going to be more of a rental mentality. And so we're not going to buy that community in an area that we can't convert because there's no demand. We're going to focus on buying the communities that can be converted. And it's just something that the seller has done over time. Now, there's a difference in how to look at that because we're going to underwrite that deal based on what the market lot rent would be and not what the home rent is. We're going to if we're going to put a value on the homes, we're going to put a shell value on them, meaning what can we blow those homes out as is for and not put a cap rate on that home portion of the income, just the lot rent. So it gets pretty complex because you're kind of buying two different things. You're buying the land and then you're buying the home, or you're buying that income stream and you're buying the home separately. Usually when we offer, we don't even put a dollar value on the homes because there's not much value to them.
So where are you at personally in your portfolio right now? And what's been the number one struggle in scaling your portfolio to where you are today?
So we're at about 800 lots right now in our portfolio. And that's just on the mobile home park side, not self-storage or anything else. And the biggest challenge that we've had is the management side. I mean, it takes a lot. And what I would say is that a lot of people go through this same situation. You know, you start buying, you start scaling, and then management has to catch up, right? So you're buying, and then you're like, wow, we've got a lot of stuff going on. So then you've got to catch up with staff and build those systems and create the efficiencies after you own the stuff. So it creates a plateau, then you build out the systems, and then you can start growing again. And what I would say is 2020 was a great opportunity for us to focus on creating systems and documenting processes and procedures. And we implemented EOS probably about 6 months before that, which is an operating system for our company. And so now that we've got that, we've gotten a lot more focus back on acquisitions because we've got the systems in place to better manage what we have. But you'll get to a point where you're just so overwhelmed with day-to-day operations that it's hard to focus on acquisitions and taking on more deals. So I would say that's, being honest, that's probably been what's been the biggest challenge is creating the systems and hiring good people that can handle the growth. Now that we've got awesome people in place, we're really focused again on acquisitions and scaling and growing. And that's kind of why I focused on creating the YouTube channel and other things to create more lead flow and teaming up and partnering with other people who are bringing deals from other markets too.
And there's almost no way around the property management struggle. It's because, like you were saying, you have to almost build out your own. You have to build out your own property management company because there's no one out there there's no liable companies out there to manage your properties. So that's interesting.
You have to build it out yourself. And the people that I know that have tried to go the third-party management route, I just over the weekend did a interview with a guy, a good friend of mine and a partner in some other business ventures. He has a pretty good sized portfolio. He took a third-party management and took it all back. And he took it back in shambles. And it was a very large, well-known management company in the industry. And so you have to build that out. And what I would say is if I could do it over again, I probably would have focused on documenting the procedures and processes and building out that business model, building out the business systems earlier on versus kind of hiring people. And I don't want to say winging it, but
then
kind of building it. Yeah, we
Yeah.
really could have built out the systems earlier on. So as we scaled, we wouldn't have had to pause and say, wait a minute, let's fix this or let's make this better to be able to handle more.
Yeah, but don't even go towards, like, if you were to go through it again, you wouldn't even go towards a third-party management. You would just document your own procedures and then put that in place through your own company.
100%.
Okay.
Yeah, 100%.
Got it.
Third-party management is a recipe for disaster right now in this industry.
Well, hey, Mario, I appreciate you coming onto the show. I think it's been a very informative episode on mobile home parks. I really appreciated you taking the time to sit down and talk with me today. If you guys are listening and you found some value, go check out Mario. Mario, your socials are Mario Datillo on YouTube. Is that right?
Mario Datillo Show. And if you can just go to MarioDatilloShow.com, takes you right to the YouTube channel, and pretty much Mario Datillo or Mario Datillo Show on all the socials. Would love to connect with people. Most importantly, be a resource to your viewers. I mean, there's people out there, you might stumble across a mobile home park and you're just trying to get your head around it, or you need a partner to do some aspect, whether it's raise the capital or operate the communities. We'd love to help you with that. And, you know, Cody, I really appreciate the opportunity to be able to hang out with you and talk to you about this. And hopefully we can do some business together and do some deals together in the future. It'd be fun.
Yeah, of course. Guys, and I'll link Mario's socials down in the comments below. Anyways, Mario, appreciate you coming on the show, and hopefully connect sometime next year, I think.
Yeah, Cody, let me throw out one other thing. If people are looking for a free resource on mobile home park investing, they can also check out mhptribe.com, and they can check out the MHP Tribe Facebook group. It's completely free as well, in addition to the YouTube channel. Hey, we'll talk soon. Thanks.
Awesome. Appreciate it, Mario.